Inflation significantly affects exchange rate through various mechanisms, primarily by altering the purchasing power of a currency and influencing investor behavior. Direct effects of inflation on currency value. Firstly is the currency depreciation. When inflation rises in a country, the purchasing power of its country declines. This means that consumers can buy fewer goods and services with the same amount of money, making the currency less attractive to investors. Consequently, the value of the currency tends to weaken against the foreign currency. Secondly is the investor attraction. High inflation can deter foreign investment since it erodes return. Investor may seek more stable currency, leading to a sell of the inflating currency, further driving down its exchange rate. In addition, inflation influences exchange rate through multiple channels. The first one is the cost of imports. As domestic prices rise due to inflation, imported goods become more expensive. This can lead to higher overall price levels in the economy, which affect the consumer price index and further influencing inflation expectation. Secondly is the relative price changes. Changes in exchange rate can affect the relative price between domestic and foreign goods. If domestic goods become cheaper for foreign consumers, export may increase, which potentially leading to higher domestic prices and inflation. Last but not least is the monetary policy transparency. The effectiveness of the monetary policy in managing inflation also plays a role. Countries with transparent monetary policy tend to see stronger currency in response to inflation surprises because markets are quick to adjust their expectation based on anticipated central bank actions.
Okay, so next is the terms of trade, which is this one. I will tell about what is the impact of the terms of trade to our currency exchange rate. So first, the definition of the terms of trade, which is it is about the ratio of the country's export the prices to its import prices. So it can tell us how many units of export are needed to buy a given quantity of our imports. So next, I will tell about the impact of terms of trade, which is the first one is higher export prices. This is about the price of your country's export increases. Next is the import terms of trade, which is you can buy more import things with the same amount of export. And the third one is about the currency demand, which is the foreign. It is about the foreigners. They need our currency to buy our high price export, and it can increasing their demands. And also the currency appreciation, which is as the demand for our country rises, it can value our status against other currencies. So next is the deteriorated terms of trade. So for the first one is lower export prices, which is the price of our country export decreases. And the second is the deteriorated terms of trade. Sorry. So it is about the we need to export more to buy the same of amount of our import things. And the third one is currency demand, which is the foreigners need our less of money currency to buy our cheapest export and can decreasing their demand. So for the last one is currency depreciation. As the demand for our currency falls, its can values weakens against other currency. So for the conclusion about the terms of trade, which is the terms of trade are crucial, very crucial for the factors that influencing currency exchange rate. So the next is about the improved terms of trade generally can lead to currency appreciation, and the deteriorated terms of trade generally lead to currency depreciation. However, it is important to remember that other factors are also influence our exchange rate, which is interest rate, inflation, and also economic growth. And all. Thank you for my part. So next, I will pass to the next presenter.
Hi, Assalamualaikum. My name is Zerryn Hazriny. So, one of the factors that influence currency exchange rate is government intervention. Here's how. first one is money policy, where central banks control interest rate which directly affect the attractiveness of a country's currency. And higher interest rate typically attract foreign investors looking for better returns, increasing demand for that currency and potentially appreciating it. The second one is intervention during currency crisis. In times of economic instability or a currency crisis, governments may intervene aggressively to prevent their currency from depreciating too much. And this can include selling foreign reserve or using emergency measures to stabilize the country. And next is trade policy, where government impose tariff or trade restrictions that can affect a country's balance of payment and also influencing the exchange rate. For instance, a country that imposes tariff may reduce imports, leading to a stronger currency as demand for foreign currency drops. The next one is capital control, where governments may impose capital control to restrict the flow of money in and out of the country. This can influence by exchange rate by limiting the demand for foreign currency or making it more difficult for investors to move capital abroad. And lastly, some governments choose to peg their currency to another, like the US dollar to the euro, meaning the government or central bank commits to maintaining the exchange rate at a fixed level. To do so, the central bank must actively buy and sell currency in the market to ensure that the exchange rate remains at the target level. This often requires maintaining large foreign currency reserve. So that's all from me. I will pass to the next presenter. Thank you.
Hi, Assalamualaikum. My name is Mohamad Shakirin Bin Isha Apandi. Today, I will be presenting about the political stability factor that influences the currency exchange rate. For the first factor is a government stability and leaderships. A stable government with consistent leadership policies ratios investors as they can predict future economic and fiscal policy. This predictability encourage investment in the country's assets, increase demand for the domestic currencies. For example, like Switzerland and Singapore, as we know, for their political stability and their currencies. Swiss is francs and Singapore is dollar, are considered strong and reliable. For the policy continuity, political stability fosters continuity in fiscal and monetary policies. Change in leaderships or government can lead to shifts in policy which might affect the currencies negatively. When investors perceive the potential for abrupt policy change, they may avoid investing, leading to capital outflow and currency descriptions. For the rule of law and effective institutions, the presence of a robust legal framework and transparent institution promotes confidence in a country's business environment. Effective enforcement of contract, protections of property right, and a fair judicial system reduce the risks of corruption and the financial mismanagement, which strengthens the currency. For example, as you know, Germany have a strong institution, tends to have stable currencies in euro, and investors trust the stability of the financial system. For the political risk and investor confidence, political instability such as frequent protests, corruption scandal, or civil unrest lead to political risk. This risk causes investors to move their capital away from the country, reducing demand for the local currency and leading to these depressions. For the geopolitical tension and external relations, a country's geopolitical standing, relation with neighboring countries, participation in international relationship organization influence the economic environment. Diplomatic tensions, military conflicts, or trade war can lead to currency depreciations due to the reduced investors' confidence. For the electoral outcomes and political uncertainty, election sections or transition in government can lead to periods of uncertainty, especially if candidates propose radical change to economic or foreign policy. During such times, currency value may experience volatility as investors await clarity on the direction of future policy. For the public debts and the fiscal policy, political stability influences related to government spending, taxation and management of public debts. Government that can manage debts level prudently is seen as least risky supporting its currency. Conversely, if political instability leads to irresponsible fiscal policy, it can result in inflation, high debt level, and a weakened currencies. And corruption level. High level of corruption, as we know, undermine political stability by creating economy and efficiency and misallocation of resources. It also reduces foreign investor confidence as it increases the risk of doing business in that country. Continues, countries with lower corruption tend to have a stronger and more stable currencies. For example, like Denmark and Finland. Legal and political crisis. Legal and political crises such as contested election, coups, or national protests often lead to uncertainty. This can reduce foreign direct investment (FDI) and capital inflow, as investors may seek safer market or liquidity their holdings and company, resulting in a fall in the value of the local currency. And the last one for this factor is about capital controls and economy nationalism. Government that enacts capital controls or pursues protectionist economic policy, for example, the tariff, currency manipulation, or import bans, may cause investor anxiety. In a politically unstable environment such policies can cause foreign investment to decline, leading to capital flight and depreciations of the currency. For example, China has at times used capital control and investor and interventionist policies to stabilize and admit political concerns about maintaining their economic growth. And that's all from me. Thank you.
Hello and hi everyone, my name is Nurul Hidayu. So today I'm going to be talking about confidence and speculation, which are one of the significant factors influencing currency exchange rate. So here's how they play a role. So in terms of confidence factors, these reflect how investors and traders perceive the stability and future prospects of a country's economy or currency. So the first one that we're going to be talking about is economic stability, which countries with strong and stable economies typically have higher investor confidence, leading to a stronger currencies. Next is political stability. Political uncertainty or instability decreases confidence in a currency, causing it to depreciate. Next is central bank policies. Confidence in a central bank's ability to manage inflation and interest rates can impact currency strength. And last but not least, fiscal policies, which are balanced budgets or manageable debt levels, increase confidence while excessive deficits erode it. Next is speculation factors. These involve market participants' expectations and reactions to economic events or trends. The first one is market sentiment. Traders' collective beliefs about a currency's future performance can drive exchange rates. For example, optimism about a country's growth might lead to currency depreciation. The second one is economic data releases. Speculators react to key data such as GDP growth, employment figures, and inflation reports, which anticipating currency movements. And last but not least, interest rate expectations. Speculation on future interest rate changes can lead to short-term currency fluctuations.